Most people in Thailand don't buy their home in cash. Most of them choose to borrow from bank and pay installment every month for more than 10 years. As we can see from this graph, number of Thai people who have to pay more than 2 home loans simultaneously are increasing year over year. It is forecasted to reach 22% in this year. The question is, do all of them the real demand? There are two main reasons that the number is too high. First, banks don't stick on the credit underwriting standard. They lend to people who have low credit rating. As a result, people borrow without ability to repay. Finally, it's become a bad debt. Second, some people purchase house or condo not to live, but to earn rental yield or capital gain. These people borrow at 3 to 4% from bank to buy a house or condo, then lend to other people at 4 to 6 rate. As a result, they are able to make profit. This investment assumes that market is in a good condition with increasing trend. However, there are some risks that shouldn't be ignored. As people are buying more and more real estate, demand increases. Therefore, developers launch more projects to meet that demand, leading to a highly competitive market. When market is highly competitive, it is more difficult to rent assets at desired rate, and then the risk begin to arise significantly as borrowers can't find the adequate cash inflow to fulfill their debt obligation. To prevent this situation, government launched macro-prudential regulation that aim to mitigate risk to the financial system as a whole. This regulation can regulate two types of people. First, people who want to borrow 2 or more home loans at the same time. Second, people who borrow more than 10 million baht to buy house or condo. These people are required to have at least 20% down payment as a condition to borrow, in order to mitigate the risk we call credit risk.
So today we're going to talk about this type of risk. Credit risk is a risk of default as a borrower fails to make a required payment, and it comes with borrowing or having a debt obligation. So now let's move on to the history of lending. Lending in any platform is pretty much second nature and probably extend way back into the midst of time. Now that's not to say there is no document about the history of loans. In fact, there are historical documents dating back thousands of years that show the evolution of the loan industries. Some of the earliest monetary loans have been documented in the Bible. Other cultures, including Romans or Greeks, have ample evidence of a thriving lending industry that dates back thousands of years. But the oldest record goes way back to Assyria and Babylonia, where merchants made grain loans to farmers and traders.
Here's come the questions. Why do people borrow? For a new car? Or for the educations? Or for the new house?
When we were sailing on the Sound.
Oh yeah. For shopping?
Trousers. Tapered. How about the lining? Tactical.
Even for Christmas? However, we will talk about another purpose of borrowing. Leverage results from using borrowed capital as a funding source when in ways to expand the firm asset base and generate the returns on the risk capital. Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital, to increase the potential returns on an investment. Leverage can also refer to the amounts of debt a firm used to finance assets. When someone refers to a company, a property, or an investment as a highly leveraged, it means that the item has more debt than equity. Okay, so here's come the question that why and when people gonna need leverage. The example is when there is a super attractive investment asset that can generate a very high returns in terms of investor view, and it should be in ways as fast as possible to maximize the returns. However, investor doesn't have enough money during that time, or let's say he have a limited capital to finance the investment. Therefore, he decided to use the leverage method in order to finance. Let's look at the flow of these situations. When there is an attractive investment asset, investor will want to speculative on it. However, they have a limited capital and the investment strategy need to take action now. So, investor will probably borrow from the bank. The bank will give investor a loan, which in return for interest in every month and the principal at the maturity date. After that, investor will take the money to invest in the asset that they prefer and wait for the returns. If the market performance acts as what investors expect, there may not be any problem occur. Everything will be fine. But once the market is not what investors expect and they cannot get the returns, they will have the lower ability to pay back the loans, and that will bring a big problems. Since the money that the bank lend to investors come from people deposit, therefore when investor cannot pay back the money, it means that bank lost people money. If these situations happen a lot, the bank will not have enough money to give back the deposit when they need the money back. The government also concerned this issue as well, so it implement the rule that each bank have to reserve the money with the central bank at a specific ratio. So it can make sure that when the bad situation happen, the bank still have some cash to pay back to the depositor. It appears that in these situations, everyone also bear a credit risk. And the downside of the leverage is that when investors cannot find the money to pay back the loans, therefore they have to lose all their collaterals. How can we prevent the credit risk from the leverage? As an investor, we can use leverage ratio which is equal to total debt over the gross income. This ratio will help you understand the level of your debt you are into the relation with your asset. By use 4 factors to consider when determining your leverage ratio, which are duration, rate, income, and liquidity. For the durations, it is how long is the borrowing period. The rate is the interest rate on your debt. For the income, it is your monthly gross income in relation to debt service. For liquidity, it is how many months could your liquid assets cover your monthly debt payment.
We might think that credit management is only a big deal for you. But banks are also one of the most significant players in an economy who control the flow of money between lenders and borrowers. Due to banks' business model, they can't avoid credit risks. Every cent they lend is exposed to the risk that they might not get those money back. And of course, no one can forget the result of ignoring credit risks, which lead to the worst nightmare in financial market, subprime crisis. So we will first do a quick recap on the subprime crisis to learn about what it looked like if banks fail to manage credit risks in corporate world. So let's begin. After a dot-com burst, Fed decreased the interest rate to as low as 1% to slow down the whole economy. On the other hand, this incentivized banks and other financial institutions to borrow a lot of money, seeking for great investment. Therefore, there is only one question remain. Where should I put this money to make even more money? Luckily, in US 2007, it was the same time during a boom in housing market. At that time, house prices seemed to increase so fast and forever, making everyone want to invest in this lucrative market. And of course, bank is not an exception in this case. So after bank had decided to invest in housing market, they still wonder how to invest their money in this market. They don't know the way to monetize this. However, before long,
there is a wise broker who come up with an idea to allow both investors and banks to make money on housing market through a financial instrument they call CDO or collateralized debt obligation. So let's see how CDO works. When there was an investor want to invest in housing market, they can just do it by purchasing CDO, which is one kind of mortgage-backed securities. Basically, a CDO is formed with thousands of mortgages from 1,000 homeowners in US. Banks leverage a lot of their monies to purchase more and more mortgages to make a large enough CDO to maximize the return and credibility of their security. Then the cash flow from CDO comes from homeowners who pay interest to their mortgages. Then those mortgages pass those money to CDO, which is finally distributed to the investor. And banks finally charge a really nice commission to manage this mechanism. But of course, these things only are not going to make CDO become more special than another fund in the market. Actually, CDO is a really nice investment option because it allows investors to choose the risk level they want. To visualize this, normally CDO will be sliced into 3 different parts by risk level and return that investor gonna get. The lower risk part provides 3% return. The moderate risk part provides around 7% return. And finally, the high risk part provides up to 11% return. So variety of investors can easily invest in CDO with their return preference. For example, insurance company or retirement fund can invest on a low risk part. Typical investor can invest in the moderate risk part. And finally, hedge fund can choose to invest in the high risk part as well. So these special characteristics turn out to be such a nice investment for everyone in the market. During CDO becoming more and more popular, no one knows that the subprime crisis has been trickling slowly. As investors want to buy more and more CDO, however, it has been running out of mortgages that banks can find in the marketplace. As a result, a large increase in demand are not compensated with the supply in the marketplace. Therefore, banks don't want to leave this opportunity to make more money out of the CDO. And to solve this problem, banks begin to create more supply again. Now, they started to lend their money to new homeowners more easily. No proof of income, no employment history, and no down payment are needed. As a result, banks start to have higher low-quality, high-risk homeowners in their loan portfolio, and this speed up the time to subprime crisis. So with a lot of bad debt, many homeowners fail to repay interest to their mortgages. Now more and more mortgages don't have any cash flow come in, making CDO cannot provide money back to pay an investor. Now, banks become the only one who responsible to pay out the dividend they guaranteed to pay to investor before. But with an extreme leverage, this amount is already too much for banks to responsible, forcing them to fail to pay anything to the investors. Finally, many banks in US were running out of money and they became bankrupt. Now, Wall Street faced the biggest crash, forcing even the fourth largest banks in US, operating for over 150 years, Lehman Brothers, to bankruptcy. Now, the value of housing mortgages dropped more than 90% of its value in less than 2 years, making the whole housing market plunge, affecting not only the US economy, but global economy around the world.
With this case study on the subprime crisis, every key stakeholders in an economy, including individuals, banks, or even the government, have learned one of the greatest lessons from this event, and no one, of course, wants history to repeat itself again. So banks around the world has been developing a number of ways to manage credit risks properly.
So let's see how banks actually do it to prevent credit risks. One of the most important methods that banks around the world currently use is credit scoring system. So basically, credit score is the method that many banks and credit analysts use as a numerical expressions to represent the credit worthiness of a borrower. It is the process of quantifying aspects like characteristics, which is the background of the borrower, repayment ability of their income, and collateral such as their house and property, and finally loan condition, which includes amount of loan, interest rate, and payment period that all need to be suitable to each borrower. And all of this will be scored to indicate the degree of creditworthiness of each borrower. Moreover, banks also use other methods like KYC or Know Your Customer, which banks could obtain information about the identity and address of the customers, or increase the premium rate, or set fraud interest rate, set up loan covenant, and be more strict on auditing and monitoring process during the loan as well.
Now, let's see how the government itself reacts to the credit risk. We can learn from history that not all governments are well responsive to credit risk. One example can be learned from Thailand. The Thai mortgage loan industry has been growing for the past years. The financial institutions have been facing a very strong competition, especially in setting price and promotion. This strong competition led to the point where the loan issuance standards tend to be lower as well. So now the question arises, what did they actually do? Due to the strong competition, banks have increased the credit line from the past. The credit line is an arrangement made between financial institutions, like banks, and their customers, and it is the maximum loan that a customer could borrow. Banks also offered many attractive campaigns. For example, they offered cashback campaigns that allow customers to take loans even worth more than the house value itself. Furthermore, banks extend the repayment period. This arrangement reduces the installment payments for customers and further motivates them with very low interest rates for the first 3 years. Lastly, the banks lend with the loan-to-value ratios as high as 90 to 95%, while other countries employ the average of only 70 to 80%. The loan-to-value ratio is a ratio that describes the value of the loan as a percentage of the value of the property, together with the top-up loan amount, which could stretch more than 20% of the total loan. This results in a loan-to-value ratio of even more than 100%. However, mortgage loans with loan-to-value ratio more than 90% are increasingly issued by the financial institutions, according to the statistics from the Bank of Thailand. And even though banks have extended the repayment period, the repayment ability of borrowers does not seem to increase, as seen from continuously rising loan-to-income ratios. Besides that, the non-performing loan ratio has been continuously increasing over the years to a point of 3.38% at the beginning of 2018, which is the highest level in 8 years. And surprisingly, The highest non-performing loan ratio appears to be from a luxurious home worth 10 to 20 million baht. It goes from bad to even worse when more and more people borrow the mortgage loan for the second and third home concurrently besides the first one. Yet they tend to have less and less gross income, and this results in a great increase in the non-performing loan for the second mortgage loan. Many stakeholders have raised concerns whether the market is growing in a stable condition, so the government stepped in to control the market more closely. The Bank of Thailand has set standards for financial institutions to follow. At the firm level oversight, also called micro-prudential, the Bank of Thailand requires each bank to report mortgage loan underwriting data more often. They upscaled the reporting from once a year to once a month. Besides, the Bank of Thailand support macro-prudential regulations. It's the approach to financial regulation that aims to mitigate risk to the system as a whole. The Bank of Thailand further employs preventive measures that support microprudential supervision. The loan-to-value threshold is an example that the Bank of Thailand normally uses. Most countries set the loan-to-value as a hard limit or a maximum percentage a bank could lend. However, Thailand currently sets the loan-to-value as a soft limit, allowing banks to lend beyond the threshold set with higher capital needed to maintain. So recently, the Bank of Thailand has announced new mortgage underwriting standards for banks to follow from April 2019 onward, with a higher amount of down payments required. The top-up loan will also be included when considering. These new standards will basically be beneficial for all the stakeholders. Buyers who have the real demand can buy houses at reasonable prices and borrow at a repayable level. Investors will not overlook the risk. The real estate developers can better plan future products based on real demand. Financial institutions have better quality mortgage loans and are less subject to risk of price change. And the overall economy can grow more sustainable.